Hello, everyone. So today we got a very exciting stat to look at. We're going to look at Amazon, which is ticker AMZN. So I'm pretty sure all of you probably know this company in general. You probably used it in your life a lot. But we're going to be looking at the stock today and seeing if it's overvalued or undervalued. So thank you for tuning in to another episode. So currently we see this is trading at a stock price of $238.82 at the time of this recording. We can look at some trends. So down for the week, up for the month, up over 3 months, year to date, pretty flat. 1 year doing good, 5 year great, and then if you look at the max, obviously great. So this is no secret, big retailer, big tech stock, basically, trading at those high margins and all that. So it's pretty in line with what we'd see with a lot of these AI companies. But Amazon's been around for a while now, so they got more of an edge. Basically we're going to highlight some parts of the business first. They're a retailer, so they sell things through Amazon.com, right? They either send it through themselves, so they store it at warehouses, or they have individual sellers sell the items too. And then they also develop some of their own items with Amazon Basics. Then we got AWS, Amazon Web Servers, and they have cloud computing servers, storage, and databases. So people can outsource a lot of the computing power to Amazon or use their storage as well. And you got kind of miscellaneous businesses in there. I mean, you can look at the Prime subscription revenue as its own thing, or endeavors like Slate, where they're trying to make their own vehicles. So they like to experiment pretty broadly. They have a large moat with their current logistics network they have. They have the name brand Amazon. I mean, if you're thinking about ordering things, you're like, oh, I'll order it off Amazon, and no one really says I'm ordered off Walmart. Amazon kind of is like go-to for ordering things online. They have a large team. I mean, they have a great employment method where they just cycle through employees very fast, and they're actually running out of people to employ. That's how large their network is. And then they got deep pockets, of course. The assets, the cash on hand, the revenue, and the cash flow. Yeah, it's all up there. So they have money to spend on growing. Now let's go down here on a couple things. Just look at it. So they're currently at a market cap of 2.56 trillion, which puts them as one of the highest market cap stocks in the world. PE ratio 33, which isn't crazy considering the type of business, but yeah, it's on the higher end. And then you got some trading volume, 52-week high of $258 and 52-week low of 160, so it's swung quite a bit this month. And then if we look at a couple things, Robinhood users have been typically buying this. Hedge funds about flat, maybe more buy. The insiders, people are selling out, but that's not really a surprise. 95% have a buy rating. And then Morningstar has a 3-star value, and they are saying fair value is at $260, so a little above what they're trading. I mean, you got like 10% upside with the current value if you're going to take that at face value. So now, with all that in mind, we're going to look at a bear case, a bull case, and then get into the financial metrics and actually do a DCF to see what this theoretically should be trading at. So first thing, I want to talk about the bear case, seeing the issues they're kind of running into. And I had chat generate me some prompts here. So we're going to be comparing Amazon Web Servers with Azure, which is Microsoft, and Google Cloud through Google. And you can see a couple things here. Azure and Google Cloud have a lot of market share as well. So it's not like AWS is a monopoly by any means and doesn't have that much market control. And something interesting I find here is that you'll see under Azure deep integration with Microsoft products, Office 365, Windows, and Teams. So yeah, they have a strangle on like the corporate side of the world. I mean, the Microsoft suite is very popular, and Azure just runs hand in hand with that. So if a business has to use something like computing, Azure is kind of first to come to mind. Although Amazon Web Servers also do have a lot of the corporate side, they focus more on average user use and not just maybe large corporations. And Google is very fast growing currently. I mean, it's just known by the world. They have a very strong brand. Then I did want to mention over here TPUs, which they have looked at selling to companies like Meta, which are just in competition of GPU and more specialized for AI and a lot cheaper. So Google has that going for them. They're developing their own TPU chips, and maybe that could help them grow in comparison to AWS and Azure. And then if we scroll down here too, you'll see cloud revenue, and you can see charts here. AWS is obviously way at the top. I mean, you're seeing $120 billion in annual revenue up here. And then next competition is Azure, which is shy of 80 billion. So they're still a little behind, and you can see Google didn't have much growth here, as well as we're trusting this chart. So basically, it says, yeah, they're all very big companies, generate a lot of revenue, but Amazon Web Servers is definitely in the lead. And a couple things with this, um, along with the bear case, you have the possibility of AI compute expenditures continuing to stay up and depreciation becoming faster and faster. So a lot of companies are spending on AI right now, right? They're building out these data centers so they can process for other companies, for themselves, buying GPUs, very expensive stuff, especially with the demand of it right now, and electricity and the infrastructure, quite frankly, at the end of the day. So those are going to put pressure on free cash flow margin. I believe we got this here. And this is a good chart that shows basically the growth of capital spending when it comes to AI and how companies have had to spend more and more. And if you look at 2004, it's a night and day difference. And even something like 24 to 25, you're still having a large amount of more spend. And 26 is projected to still have more, even though they've already spent so much. So that puts a lot of strain on their free cash flow margin, which directly affects their valuation, of course. Then another issue I'm familiar with Amazon is return frauds. And now, obviously, this affects the company in general because they have to pay for that shipping because they generally pay free shipping back or maybe $1. They're going to have to pay for more. Even with their logistics network, they're going to have to pay for it, manpower, cost of the postal office, all that. But also, individual sellers sell on Amazon. And if these return frauds continue to rise, Amazon, which depends on a lot of independent sellers and independent businesses, a lot of those companies are just going to pull off and make their own website or go with another network if Amazon isn't there to defend them in these cases and maybe supplement some of their losses from people just returning products because it is very easy and convenient, and Amazon makes it that way for users. So this could also put a strain on Amazon's seller network, which is a very large portion of their revenue. Now, if we go into the bull case, we have a lot of stuff going on here. First, I'd say AI improves systems and reduces needed labor. And although there isn't necessarily a direct chart you can show this, I think a great representation is showing how much total monthly users you have of ChatGPT, because this is more or less people using it in their daily lives. If they're using it, they probably find use out of it, right? I know personally I use it. I just showed an example of using ChatGPT. So if you can use it in your personal life, you can definitely use it at work. There's applications there too. So people are using it. And you can see from this chart as July 2024 to November 2025, so a little older. But the monthly users have just been shooting up, especially in May 2025 here. We see that is kind of seeing more wide adoption. So yeah, that is incredible. And this is just ChatGPT alone. This doesn't include things like Gemini or Claude if people are using it for code. So that's just an overall theme of AI improves systems and reduces labor costs. So yeah, obviously that's going to help revenue and margins. Businesses of scale continuing worldwide. Amazon could continue, scaling up their operations like they have been, and then maybe see more penetration in other countries, something like India with such a large population that they're not quite into. They primarily are dominating in the states. Places like Canada, Mexico, if they're able to develop systems there further and further, there's still a lot of market share out there for them to go after for revenue. Reducing capital expenditures if AI starts to peak with performance. So we've seen, and this kind of up in the air, but we've kind of seen things where AI maybe is peaking in its capabilities. I mean, people talk about generative AI and how AI is going to be able to solve cancer and all this stuff. Okay, well, maybe we're getting a little ahead of ourselves, right? In reality, AI might be getting to that point where it's like, hey, this is as useful as it will be with this current methodology of developing the technology. So just using the standard AI networks and taking in more and more data, we're kind of in the limit of what an AI model can do. So there's that. And if GPUs, continue to improve, maybe, but marginally, then they won't have to keep spending as much money and hopefully get some more useful life out of their assets on hand. And on the flip side, for the bear case, if GPUs and TPUs improve very fast, then the depreciation is faster for the assets. So that's the worst case situation with it, which is what we've been seeing a little bit. So maybe we could see some peak and that would help the valuation. Then I got providing AI and GPU computational power, servers continue to grow. So yeah, obviously I showed you this large data spending chart, and although that is true, this is not necessarily bad. This is capital expenditure. They're investing in their company. And if this investment pays off, they spent a lot of money to make a great return and position themselves in a great point in the current market they're in. Because quite frankly, all companies are spending on AI and data centers like this. So if Amazon didn't, they would simply fall behind. But they're all kind of banking that it will more or less pay off. So that's the big question: is it going to pay off? And that's something you can kind of project when you come to free cash flows and revenue growth and all that. But nobody knows necessarily. So we just have to kind of assign some probabilities there. With all of this, the bear case, the bull case, where the stock is currently trading at, and what Morningstar thinks, it's important we actually look at the metrics then to give ourselves a valuation and maybe get an idea of where we can expect this to be trading at. So if you want to take a second to look at these numbers, go ahead. I'm not going to actually show the table, but we'll look more as the charts here. So yeah, here's a time series of the revenue starting from 21 to 25. That's where all this data is going to be going. You see revenue up and to the right. Some peaks kind of in that Q4, very expected with being heavy in retail. And then you can see the revenue difference, and we're quarter over quarter looking at like a 4% growth. So that's definitely strong. Nothing to worry about there. Time series of free cash flow, and this is going to affect some of the differences. So we're not going to take too much attention to free cash flow, but you can see they were very negative in I'd say about mid 21 to mid 23. They were burning money up, and a lot of this was simply the fact they were just investing in the company. So that's going to affect the difference chart on the right because we're looking at negative numbers here. But it just kind of puts in this point that Amazon isn't afraid to spend, and they will spend if they think it's a worthwhile return on investment. And that's a lot of the situation we're seeing. I mean, look at the free cash flow they were generating in mid 23 to beginning of 2025. But then, yeah, AI computational and data center spending picks up, and then of course their free cash flow is going to drop because their operating expenses and their investments into new assets are just piling up fast and fast. So it's just going to put a lot of that pressure on the free cash flow. Then we have the time series of the EPS diluted. So this is important. Your EPS for a company earning per share might be increasing, which is good in itself. But if a company is issuing a lot of shares, that's just you're kind of hiding behind the fact. So this is EPS with shares accounted for, so new shares being introduced, and obviously if some shares are bought back, that's going to be into it. And time series for EPS diluted has been increasing, which is great. We love to see that. So it's getting better and better for the stockholder, and obviously this falls in line with a lot of that free cash flow, and you can see the heavy expenditures. And even with the heavy expenditures in 2025, the earnings per share have actually been incredibly great and actually increasing in despite of that. So love to see that. Very, very strong chart. And then operating income goes in line with a lot of these revenues. As you grow a company up, more you might be making more money, but guess what? You have to spend more money. It's just kind of how the system goes. So you can see that the difference in operating income growth has actually been decreasing. So although it increased for a lot of time between 2022 and 2025, that rate has been slowing down. Now, if it'll look like that in 26, I'm not sure, quite frankly. But so far, it seems like it's kind of took a little bit of a turn on a downtrend, which um, is good to see. Oh, well, that's operating income, so revenue, but you'll see operating expenses, kind of follow that trend. Operating expenses have been steadily increasing, but at a pretty predictable amount and not really growing too fast. So we'll kind of compare that down here. We're going to be looking at the revenue and operating expenses of Amazon. And this is the difference quarter over quarter. So you can see that generally in this time period, revenue has been increasing at a faster rate than operating expenses, which is good because that shows that they're making money faster than it is costing them to make that money. So we've been seeing that, but it doesn't hide the pressure that if you look back here, yeah, your expenses were increasing at a faster rate, and then look at 2025 here, it's actually starting to overtake that. So is that AI and computational spending? Yeah, sure, it probably is, quite frankly, but we can't hide behind the fact that they're spending a lot of money, and it's an investment, sure, but it still affects your valuation of your company. Just because it's an investment, you think it's going to pay off, doesn't change the fact that you are spending money and taking off your balance sheet. It's quite frankly what it is, and that's all to be accounted for when it comes to the valuation of the company. So yeah, you got some quarterly metrics all on the same thing here if you want to take a second to look at that. But we're going to go up here and actually take some valuations now. So we got the three cases. We got the bear case, average case, and bull case. And I got some side notes here. So bear case, continual capital expenditures. So they're just going to have to keep spending on AI and data centers, which is a fair possibility, but maybe not if it starts to peak out. And then say they have slowed revenue growth. Maybe they run into more competition. So I would argue in this case, we'd be looking at something like a growth rate of 12%, sustained growth rate of 9%. And I said the high growth for 6 years, maybe a little ambitious, and the sustained growth for 10 years. Free cash flow margin, I said, is about 5%. Discount rate of 10%, which is pretty standard. Maybe 9% is more standard, which we'll see down here. And then perpetual growth of revenue at 3%, basically just inflationary when the company peaks out, more or less. So with all these figures in mind, this gives an implied price of $101, which would mean we're overvalued by 57.4%. So obviously that's not good. And that's why we say it's a bear case, right? This is like worst case situation, basically what could be happening with the stock, okay? So then let's look at the average case. I'm going to say capital expenditures return to normal, so they have to stop spending as much, and then we retain our current revenue growth. So you'll see we use a 12% revenue growth for the bear case, but this revenue growth is saying, hey, 4% growth quarter over quarter, and then we're going to annualize that and see what our growth is, and that's 16.99%, just about. And we're saying that's for 6 years, sustained growth rate for 10% for 10 years. And free cash flow margin of 7%, which is where they're about currently at. That number is directly affected by how much money is being spent, but kind of pre-high capital expenditures, that's where they were kind of running at. So we're going to say free cash flow margin of 7%. Okay, and then discount rate of 9%, that's pretty standard. And then obviously we're not going to mess with the perpetual growth. And in this case, we're trading about even, quite frankly. I mean, overvalued by 1.91%. That's a margin of error there. You know, a stock can swing 3-4% in a single day. So that's, I would say, about fair value in the average case. So that's pretty cool to see that people are more or less banking on this average case situation if we're going to take the stock current trading price to be any indication. But now we have one more thing. We have the bull case. This is kind of if Amazon kind of knocks out of the park, quite frankly. And that's saying capital expenditures return to normal. So same as the average case, but we see increased revenue growth and subscriptions. So increased revenue growth, that's just saying, you know, they're getting more revenue at a faster rate than they currently are, which is something they could definitely do. But I also put subscriptions in there because I think about things like Amazon Prime, and then like if they release their slate car, if they have some sort of subscriptions, which a lot of automobile people are doing. I mean, I think a Tesla with full self-driving recently announcing they're doing a subscription model. I mean, I could see the slate having an add-on where it's like, okay, this thing can also drive itself, and you have to pay a subscription, things like that. Or maybe if they spin off the Amazon Retailer Prime and they also spin off the Amazon Video Prime. I mean, those are two different things, right? You got the retailer, which you save on shipping, and then you got the Prime Video, which is like a streaming service. And currently, it's kind of bundled into that same price right now, about $15 a month if you don't have any sort of discounted plan through life situations. But they could realistically spin them apart. I think people would still pay for both. I mean, I might. I like Amazon Prime quite a bit, and maybe it's because I have them both tied together. But you also get a different selection on the Amazon Prime network than something like Netflix or Hulu. So I'm kind of saying maybe they can spin it off and make more money that way. Another thing I wanted to put into the bull case. So the difference is in assumptions here, we're going to say high growth rate of 20%. So 3% more a year, nothing too crazy. You know, you really got to push it to get there. And then a sustained growth rate of 13% over 10 years. So yeah, they continue kind of gaining market share over the next decade and really pushing at it. Free cash flow margin of 8%, so they just push it up 1% more, and discount rate of 8%. So saying maybe the market isn't so hot at that time, so you can discount like that. And then you got the perpetual growth rate, same share amount, same. With this bull case, with these slight assumption differences, they actually make a major difference. You can see the implied price of $480, which says we're undervalued by about 100%. So we're trading at half the value of what it would actually be. So Amazon's a very interesting situation where just changing those initial numbers a little bit, if you're more bullish on the company, can actually make a large impact with the stock valuation. And when you look over longer time periods, and if you already have a high revenue to start with annually, yeah, it can definitely make a large difference, just making slight changes. So what I'm going to do with these numbers is apply a probability to each situation. Okay, so I'm saying that the bear case has a 20% chance of happening, the bull case has a 20%, then the average case is 60%. So with all that, when you take in the percent and the value derived from each of those situations and add them up, you'll see that it says we would currently be at a fair value of $257. And currently we're trading at $239.12. So you have about a 7% upside. Now that's good to see. I mean, it implies that Amazon is undervalued looking at their metrics, which is cool. But I always make the argument of, okay, is that good enough for you? And maybe it is for your situation. If you're like Amazon, just need something to justify your buy more, maybe that number is good enough for you. But for me, I would rather look at something more undervalued by 30, 40, 50%, right? If, even with all these situations in mind, if you find something with more opportunity there, it could be a better buy. Because when you have a 7% undervalued, that's a lot of opportunity cost put on the table because the stock could realistically swing 8% in a week. They could, great earnings report, they could just knock out of the park, especially if you're in a bull market. So that wouldn't be anything crazy. And then at that point, you're going to be like, okay, well, I'm at fair value, with these metrics taken into consideration. Should I sell out? And then you have to look at another stock to put your money at. Otherwise, you're just putting money on the table. So something to keep in mind. And we can look at a couple things here. So we got a lot of metrics to look at here. You got the stock price in this like light gray. You got a 50-day moving average in the black, and then you got a 200-day moving average in the orange. And if you see recently, there was a little bit of a downtrend in 2025 where the growth slowed down, but the 50-day moving average has taken over that 200-day moving average. But there are times where it's been trading below. So sometimes Amazon's a little hot, sometimes it's slowing down. It's a little wishy-washy with that in that terms. And then if we're looking at a risk-adjusted basis, more or less a Sharpe ratio without a bond rate more or less implied in it. Just take the return divided by the standard deviation. You'll see Amazon's Sharpe ratio in the red here, and then the S&P in the black. And then when we compare them, positive is good here. It means a better Sharpe ratio, so risk-adjusted return for Amazon. You can see that, yeah, generally it's been trading above the market, so you're getting more bang for your buck, even with the volatility in mind. But there's still the points where it underperforms, which I'm looking at the beginning of 2022 to about the beginning of 2024. So you have a 2-year period where Amazon really wasn't trading that good on a risk-adjusted basis. And then let's look at just annual returns of each stock. You see Amazon in blue, the SPY in the red, and the green bar represents the alpha. So the difference, how much more it's making or how much less it's making than the market. You'll see that most year, yeah, it's given a positive alpha. It's trading above the market. I mean, you got 34% here, 60% here, 56%, and then 21% alpha. But something to keep in mind, if you look at these years, Amazon dropped 50% in 2022. That's a lot of money, to lose in a single year, right? And that's an alpha difference of 30%. The market only dropped 19.48%, which is a lot. But in comparison, you're losing half your value of Amazon there. So you're going to have the decay. And then here, I mean, Amazon returned 2% in a year that the market returned 27%. Okay, so factors like this, you have to consider that it might be going up. You might be making money on the stock, but you got to compare it to the market. Are you making a lot more money than the market? Are you making it at a risk adjusted return that makes sense, which it seems like we are? So Amazon in general has been performing well in that aspect of finding alpha. And then, yeah, we got some free cash flow margins over here. Just kind of justify what I was showing earlier, pre-expenditures that they were trading kind of around that 6 to 7 free cash flow margin percentage there. So kind of just justifies it. And we'll go back here just so you have a couple numbers to stare at. Point being that average case says Amazon is about trading at market value. And then if you take all these situations into consideration with their respective probabilities, it says we're about undervalued by maybe 7%. So there is potentially a little bit of a margin there for a buyer. And now let me, of course, encapsulate this with this is not financial advice. I'm not a financial advisor. I'm simply doing a discounted cash flow based on the metrics I was able to find online to the best of my knowledge and just taking some of my personal opinions. I do not have any stake in Amazon. I don't really plan on buying it anytime soon. unless you're counting my market funds. So thank you for tuning in. I have been enjoying doing these videos. I'm going to try chugging them out at a little bit of a faster rate because I got a nice system going here that's a lot easier to work with now. So thank you for tuning in. Make sure to like, subscribe, share the video with your friends, and tune into the next one. See you guys.